Passive income rolling in each time a car glides through soft blue brushes, credit card reader beeping while you sip coffee miles away. But here's the brutal truth nobody whispers. The average express tunnel sits idle, burning fixed costs, for 18 hours daily. A car wash looks like the ultimate absentee business. No inventory to spoil, no cooks to quit mid-shift, customers who literally sit still while billed. But here's the surprise. The wrong site can leave you scrubbing loan payments for a decade, water recycling mandates can double utility bills overnight, and a single winter freeze can shred hundreds of feet of PVC, halting revenue for days. And here's what nobody tells you. Wall Street is paying billboard prices for foam cannons because they've cracked a membership code that transforms weather gambling into utility-like annuities. Today we'll dissect every dollar, the land deal, the $3 per car chemistry, the monthly membership war, and why private equity suddenly treats car washes like SaaS companies. By the end, you'll know whether to pour concrete or buy stock in consolidators who already did the dirty work. Industry overview. The $15 billion behavioral shift Americans spent roughly $15 billion washing cars last year, up 35% from pre-pandemic levels. But that's not even the shocking part. Convenience is the driver. 66% of US drivers now use professional washes instead of home driveways. A behavioral shift accelerated by water restrictions and condominium living. The 17,000 location sector is fragmented in ways that quietly bleed opportunity. The 10 largest chains control only about 20% of sites, leaving tens of thousands of mom-and-pop tunnels ripe for roll-up. Private equity agrees. Over $6 billion has flowed into platforms like Mr. Car Wash, Driven Brands, and Take 5 since 2020. Here's where it gets interesting. Subscription models reshaped everything. Unlimited wash clubs generated 35% of revenue in 2023 and are growing twice as fast as per-wash tickets. Weather volatility still whips demand. Volumes spike 40% the week after snowstorms, salt roads. Yet membership revenue smooths the curve, turning sunshine anxiety into predictable monthly cash that prints money while you sleep. Business models and site selection. This is where dreams die. Not all car washes are equal, and this is the part that breaks people. In-bay automatics sit at gas stations, need only 1,500 square feet, cost $250,000 to install, and gross $150,000 to $250,000 yearly. Perfect side hustles but tough to scale. Self-serve bays are cheaper, but quietly bleed quarters to vandalism and suffer app-era obsolescence. The growth darling is the express exterior tunnel, 120-foot conveyor, attendant-free kiosks, high-velocity blowers finishing in 3 minutes flat. A single express site can process 130,000 cars annually, pulling $1.2 million in sales. Location criteria are forensic. 25,000 daily traffic count, median income above $60,000, and no competing tunnels within 3 miles, or at least direct right-in, right-out turn lanes. Because membership relies on habit, drive time convenience beats destination appeal. And then there's the visibility problem nobody budgets for. Visibility equals volume. A lone pylon sign hidden behind a strip mall will doom even the shiniest stainless steel arches. Capital expenditure. The $7 million reality check ground-up express builds run $4 million to $7 million. And this is where deals actually die. Land costs dominate. A 1-acre corner parcel in suburban Atlanta fetches $1.5 million. You'll need 0.9 acres minimum for stacking lanes and vacuum plazas. Construction averages $225 per square foot, so a 5,000 square foot tunnel adds another $1.1 million. Equipment is aerospace-grade expensive. Dual belt conveyors, $250,000. 18 foam applicators and mitter curtains, $200,000. 140 horsepower blower array, $200,000. And water reclaim system, $250,000. Add $300,000 for kiosks, license plate recognition cameras, LED menu boards, and point-of-sale software. Soft costs, impact fees, architectural plans, soils tests, legal and interest carry, tack on 15%. Lenders finance 70% loan-to-value at roughly 7% interest, demanding personal guarantees unless you already run multiple sites. Your equity check? Around $1.5 million before overruns. But that's not even the part that breaks most people. Municipalities now scrutinize water usage. Expect to install a reclaim system that recycles 60% of effluent or the permit stalls for months. Operating expenses. The $580,000 annual treadmill. Despite automation, labor remains the biggest controllable line item. A typical express wash employs 6 to 8 attendants for loading assistance, equipment checks, and vacuum area tidiness, $26,000 per employee fully burdened. Total payroll, $180,000. Chemicals seem cheap but add up. Pre-soaks, triple foams, ceramic sealants, and drying agents average 70 cents per vehicle, about $90,000 annually, at 130,000 washes. Utilities follow. A tunnel consumes 25 to 35 gallons per car. Municipal water plus sewer fees run roughly 20 cents per gallon discharged, netting $75,000 even with reclaim. Electricity for pumps, blowers, and LED displays adds $55,000, spiking during summer heat when blower motors labor hard. And then there's the maintenance nightmare nobody talks about. Maintenance is relentless. Brush bearings, conveyor chains, RO membranes. Plan $60,000 plus an emergency fund for a $40,000 gearbox failure that stops production. Add property tax, insurance, marketing, and POS SaaS at $120,000. All-in annual operating expenses hover near $580,000 for a well-run site. Revenue streams and pricing power. The margin bonanza ticket tiers are psychology disguised as soap. Basic Bo 9, Better 14, Best 19, and unlimited memberships at 2 times the single wash price. National surveys show over 20% of customers convert to monthly passes, and those members average 2.6 visits, effectively paying $7 per wash while costing only $2 in incremental chemicals and utilities. A margin bonanza that prints money. Upsell scripts matter. Kiosks using loss aversion, protect your paint all winter, lift average ticket $2. Seasonal pricing is flexible. Operators raise single wash prices $1 during pollen season without denting volume. Gift cards and fleet accounts add mid-single-digit share, while vending vacuums and detailing wipes are rounding errors that still cover electricity. A well-located express site running 11,000 cars per month at a $10 blended ticket generates $1.32 million top line. With 22% EBITDA margins, you're clearing $290,000 before debt. Membership economics and data flywheel. The SaaS secret subscriptions transform weather-dependent sprees into SaaS-like revenue. Assume 2,500 members at $29 monthly. That's $870,000 a year, booked on day 1 of each month. Churn averages 5%. SMS win-back campaigns claw back half of deserters with a free month offer that costs $2 in chemicals. But here's where it gets really interesting. License plate recognition captures visit frequency, feeding a CRM that suggests when to target upgrades. The data flywheel sharpens marketing spend. Facebook geofence ads only to non-members who drove through last week on a pay-per-wash ticket. Result? Acquisition cost under $10, payback in 2 visits. This predictability explains why Mr. Car Wash trades at an enterprise value multiple higher than many quick-service restaurants. Investors see a utility-like annuity, not a weather gamble. Ancillary profit centers and the part nobody talks about vacuum plazas are free to customers but lucrative in perception. They justify premium pricing and increased dwell time, boosting concessions. Some operators rent windshield repair kiosks space for $3,000 monthly or integrate detail bays that upcharge $40 for interior cleaning. On-site pet wash stations can generate $60,000 a year in suburban markets. Vending fridges selling energy drinks and microfiber towels yield 50% margins with no payroll. Solar panels on steel canopies knock 15% off power bills while locking in 26% federal tax credits. And then there's the part nobody budgets for. Real estate appreciation often eclipses soap profits. High-traffic corners rezoned for multifamily can double land value within 7 years, providing a stealth exit optionality. Risk factors. This is where operators actually break. 2 storms loom: interest rates and overbuild. The PE gold rush means 3 tunnels can break ground within a 5-mile radius, diluting traffic counts and igniting price wars. Markets with wash density above 1 site per 25,000 residents show ticket compression within 18 months. Next, drought regulations. California's emergency rules banned driveway washing and pumped professional demand. But if municipalities target commercial users next, water-intensive operators may face surcharge tiers that erode margins by 4 points. Equipment downtime is existential. Every hour offline during a Saturday rush forfeits $1,500 in revenue. Cyber risk is rising too. Hackers hit POS systems in 2023, freezing gates until ransom was paid. Finally, labor turnover tops 120% in some states. Without a service-first culture, online reviews dive, and membership churn spikes. Asset-light winners. The Marriott moment. As with hotels and jets, the fattest margins accrue to platform owners, not site owners. Take 5 and Zip's car wash, buy mom and pops, slap on branding, centralize marketing, and skim a 5% management fee off gross sales, in addition to corporate EBITDA. Chemical supply giants earn recurring revenue without real estate risk, selling a $15 drum of ceramic sealant that retails in the tunnel for $5 per application. SaaS providers like DRB Systems charge per plate scan, earning royalties while you pay the water bill. If you crave exposure without suds under your fingernails, public equities such as Driven Brands deliver the beta of consolidation without CapEx headaches. Exit strategies and ROI math. Suppose our sample wash nets $290,000 EBITDA. Private market multiples range 6 times to 10x depending on membership mix and land ownership. If you also own the dirt, buyers pay closer to 10x, call it $2.9 million, plus real estate value appraised at an 8% cap rate on land rent, roughly another $3 million. Against a $1.5 million equity check, that's a 2.9x multiple on invested cash in 5 years, not counting annual distributions. Alternatively, refinance after stabilization. Lenders will loan 75% of appraised value, letting you recoup original equity tax-free while still owning the asset. The poorest outcomes stem from under-leveraged volume, below 6,000 cars a month, and interest-only loans that reset upward. Sudden payment hikes have forced bankruptcies even amid booming top lines. The final rinse: concrete or dividends. A car wash can be a cash geyser or a concrete albatross. Success hinges on traffic counts, water economics, and the invisible math of memberships, not the shine of the arch. Capital returns sparkle when foam cannons fire 10,000 cars a month. They vanish when 3 competitors undercut prices across the avenue. Meanwhile, the asset-light roll-ups' pocket management fees rain or shine. So before you draft floor drains and order neon arches, ask yourself, do you want to master chemicals, pumps, and weather, or would you rather collect dividends from those who do? In the car wash economy, the cleanest money often belongs to the brand, not the brush.